Today, we're breaking down PCI, the PGIM Corporate Bond 5 to 10-year ETF, an actively managed fixed income ETF designed to provide total return through a diversified portfolio of investment-grade corporate bonds from around the world. PCI targets the intermediate part of the yield curve, sitting between short-term stability and long-term interest rate risk. PCI primarily invests in corporate bonds issued by U.S. and non-U.S. companies, with maturities between 5 and 10 years. This maturity range is often considered a sweet spot for investors looking to balance yield and price stability, as it generally offers higher income than short-term bonds without the same sensitivity to interest rate changes as long-duration funds. Unlike passive bond ETFs, PCI is actively managed. Portfolio construction is handled by the sub-advisor using a combination of top-down economic analysis, bottom-up fundamental credit research, and proprietary quantitative models. This multi-layered approach allows the fund to adjust positioning based on economic conditions, credit cycles, and issuer-specific risks. The top-down process focuses on broader factors such as economic growth, inflation trends, interest rate expectations, and credit market conditions. These inputs help determine sector allocation, duration positioning, and overall risk exposure. At the same time, bottom-up research plays a critical role in security selection. Through bottom-up analysis, the sub-advisor develops internal credit ratings and outlooks on individual issuers. These internal assessments go beyond external credit ratings and are based on factors such as balance sheet strength, cash flow trends, leverage, competitive positioning, and management quality. This research helps identify bonds that may offer attractive risk-adjusted returns or improving credit profiles. When selecting securities, PCI considers multiple investment factors, including expected total return, yield, credit spread, and potential for price appreciation. The goal is not just income generation, but a balanced return profile that can adapt across different market environments. From a duration standpoint, PCI seeks to keep its weighted average duration within 1 year of the Bloomberg U.S. Corporate 5-10-year Index. This helps anchor interest rate risk while still allowing flexibility to tilt duration modestly based on the manager's outlook. Because the fund is actively managed, buy and sell decisions are driven by ongoing credit research, changes in market conditions, interest rate movements, and broader economic developments. PCI may trade more frequently than passive bond ETFs as the manager adjusts exposures or responds to changes in issuer fundamentals. The fund may also use derivatives as part of its portfolio management strategy. These tools can be used to manage risk, adjust duration, or gain efficient exposure to certain segments of the credit market. While derivatives add complexity, they can enhance flexibility when used prudently. From a portfolio construction perspective, PCI may appeal to investors seeking intermediate-term investment-grade corporate bond exposure with active oversight. It can serve as a core or complement holding for investors who want professional credit selection and global diversification rather than strict index tracking. That said, PCI is not risk-free. Corporate bonds are exposed to credit risk, and intermediate-term bonds remain sensitive to interest rate changes. Active management also introduces manager risk, meaning performance depends on the effectiveness of the sub-advisor's research and decisions. The bottom line is this: PCI offers actively managed, global investment-grade corporate bond exposure in the 5 to 10-year maturity range, with a focus on total return through disciplined credit research and risk management. For investors who prefer active bond management over passive indexing, PCI is a fund worth understanding. If you found this breakdown helpful, make sure to like the video, subscribe to the ETF Investor, and comment below. Do you prefer actively managed bond ETFs like PCI, or do you stick with passive fixed income indexes?